All right, today we are cracking open the case file on a company that, it pretty much powers every single piece of tech you own, Applied Materials. The real question is this semiconductor giant a brilliant investment, or is it just a really well-run company trading at a price that's, well, a little too rich?
So to figure this out, we're not just going to stare at a spreadsheet. We're going to apply the super rigorous four-part test from the master himself, Warren Buffett, to see if Applied Materials, or AMAT, really is a wonderful company. And then, of course, we get to the million-dollar question, should you be buying it right now?
Okay, so our whole investigation here is built on the four key things Buffett looks for. The things that separate the good companies from the truly great ones that just keep growing for decades.
Now, here's the deal. A company can't just be pretty good. To even be considered, it needs a big green check mark next to all four of these. It's an all-or-nothing game. So let's kick things off with the most important piece of the puzzle, the business itself.
The very first hurdle is all about defense. Does this company have what Buffett famously calls an economic moat? Some kind of durable, long-lasting advantage that just keeps all the competitors at bay and protects its profits year after year? The easiest way to think about AMAT's business is to picture the old gold rush. AMAT isn't out there digging for gold. Nope. It's selling the super essential, incredibly complex, multi-million-dollar picks and shovels to all the gold miners. We're talking the big guys like Intel, Samsung, and TSMC. These companies literally cannot make their advanced chips without AMAT's gear. So what actually builds this massive protective moat? Well, it's not just one thing. It's actually a powerful combination of advantages that are, frankly, almost impossible for any competitor to replicate.
And just look at how these things all work together. For a customer like TSMC, the switching costs are just astronomical. We're not just talking about buying a new machine. We're talking about recalibrating an entire multi-billion-dollar factory. The risk is huge. And you combine that with AMAT's mountain of patents, and you can see how customers are effectively locked in.
And this right here, this is the engine that makes that moat wider every single year. $3 billion. That's what AMAT spends on R&D, and as you can see, it absolutely dwarfs the competition. This lets them out-innovate pretty much everybody, building this patent fortress that's just nearly impossible to get through.
Okay, let's move on, because you can have the greatest business in the world, but it can be totally wrecked by bad leadership. So our next test is all about the people running the show. Are they honest? And maybe more importantly, are they smart with the company's money?
And the leadership team at AMAT gets top marks here. They have a fantastic reputation, and crucially, they avoid what Buffett calls the institutional imperative. That's just a fancy way of saying they don't chase silly fads or make dumb, splashy acquisitions just because other companies are. Instead, this team stays laser-focused on their main business.
And here's the proof in the pudding. They are incredibly disciplined with how they use the company's cash. Just look at those aggressive share buybacks. They've bought back so much stock that the total number of shares is down 12% in 5 years. That makes every single share left more valuable. You add in a dividend that keeps growing and smart reinvestments, and you've got a team that's all about shareholder returns.
So we've got a great business and great management. That combo should create an absolute beast of a financial engine. Let's pop the hood and see if the numbers really back up this story.
First up, return on equity. Over the last 5 years, AMT has averaged a stunning 42%. Now, to put that into perspective for you, Buffett's own benchmark for what he considers an excellent business is somewhere around 15 to 20%. As you can see, AMT is more than double that. It just shows how incredibly efficient they are at making money.
Okay, what about risk? Let's check out their debt. This is their interest coverage ratio. All this means is that they earn more than 25 times what they need to cover their interest payments. In other words, as you can see on this gauge, they are deep, deep in the very safe zone. There's basically zero risk coming from their debt.
But this chart, man, this chart really tells the story. This is the free cash flow. This is the real actual cash the business is spitting out. And you can see it's not just a lot, it's a consistently growing gusher of cash. This is what funds everything else we've talked about, the R&D, the buybacks, the dividends, all of it.
Wow. I mean, so far, AMAT is just acing this test. It is a wonderful company. It's got a wide moat, smart management, and fantastic financials. But now we come to the final, and for us as investors, the most critical question of all. What's it actually worth, and what price is the market asking us to pay?
This
is the moment of truth, because as we're about to see, even a world-class company is not automatically a world-class investment. The price you pay, well, it changes everything.
Okay, on the left, this is our estimate of the company's real intrinsic value, based on all the cash it's going to generate. We think it's somewhere between $145 and $165 a share. Now, on the right, that's the price tag the market has slapped on it. And what do you notice? There's no gap. The price is basically the same as the value.
And this right here brings us to Buffett's #1 most important rule, the margin of safety. You see, value investors want to buy $1 worth of a business for 50 cents. That big discount is your buffer, your protection, in case you're wrong or things go bad. But in this case, the market is asking us to pay a full dollar for $1 worth of business. There's just no buffer.
So here it is, the final report card. I mean, it is a textbook example of a wonderful company. Check, check, check. Great business, shareholder-friendly management, and a rock-solid balance sheet. But it stumbles right at the finish line, valuation. That price just doesn't offer any margin of safety.
So what does this all mean for you? Well, if you already own it, it's a fantastic company to just hold on to for the long run. But for someone thinking about buying in today, the recommendation is pretty clear: wait. Wait for a pullback, a market panic, anything that might give you a better price and that all-important margin of safety.
And really, that's the ultimate takeaway here. Applied Materials is, without a doubt, a fantastic business. But the market knows it, and the price reflects that quality, leaving you almost no room for error. It really forces you to ask yourself a tough question for your own strategy. Are you willing to pay a fair price for a wonderful company, or are you going to hold out for a wonderful price?